I know we're all familiar with inflation, and you've probably heard of deflation, but have you ever heard of stagflation? Is that even a real term, or are economists just making up things just to confuse us? So stagflation is real, but it's super rare. It's a combination of stagnation and inflation. So it's a period where there's stagnation in the economy, but there's also inflation in the economy. And it's a situation where both government officials and Fed officials are essentially caught off guard because they don't know what to do to get themselves out of stagflation. Hi everyone, I'm Ara Ogorian with ACAP Advisors and Accountants, and welcome back to our channel, your trusted source for tax and financial strategies, all in one place. Before we can fully understand stagflation, we need to first define inflation and deflation. Inflation is essentially when the price of goods is rising at a faster rate than wages are rising. Now, before 2020, we essentially had no inflation because as prices were rising, they were rising at a slower rate than wages were rising. But then once COVID hit, inflation really took off because then we started seeing the prices of goods rising at a much faster rate than our wages were increasing at. Look at an economics textbook, inflation is technically defined as the persistent rise in the average price level across an economy, resulting in a decline in the purchasing power of money. And that decline in the purchasing power is the lower wage growth that I was referring to. For us normal people, inflation is when you go to the grocery store and you buy a gallon of milk for $5, but just a week before it was $4 for that gallon of milk. But your wages haven't gone up by the same 20% that gallon of milk has gone up. So essentially what's happened is your dollar has lost its purchasing power because of inflation. But I want to point out that not all inflation is bad. Just like as I mentioned earlier, before 2020, inflation was still there, but wages were rising at a faster rate. So a good amount of inflation is actually healthy and good for a normal type of an economy. Now let's talk about deflation. Now deflation is the opposite of inflation, which means that prices are declining faster than wages are declining. Now you might say this sounds like a good thing, but the reality is deflation is bad because it leads to lower wages, higher unemployment, and slower economic growth. And the reason why that's the case is because both businesses and consumers delay their spending, recognizing that prices are going down, and this causes a cycle of economic decline. So now let's pivot back to stagflation. And essentially stagflation is when the economy hits a brick wall. I mentioned earlier that stagflation is a conjunction between stagnation and inflation. It's essentially a situation where the economic productivity of the country, measured as GDP, is not growing or is negative, but you have high inflation and you have high unemployment, which is a recipe for disaster essentially. It's the worst of both worlds because people are losing their jobs, the economy isn't growing, but prices keep going up. I also mentioned earlier that we experienced stagflation back in the 1970s. Back then, we had oil prices quadruple because of the OPEC embargo, which was inflationary. Then inflation soared, hitting a whopping 14.4% by the late 1970s. Mortgage rates at that time also hit a record high of 16.6% for a 30-year mortgage, which is drastically higher than what we've seen in recent years. At the same time, we had unemployment rise to 8.5%, which is almost double what we have right now. And GDP either stalled or turned negative during that time period. Now, the Federal Reserve was really caught in the pickle because it couldn't stimulate the economy by lowering rates, because if they lowered rates, they would have essentially created more inflation. So instead, Chairman Paul Volcker, who was the chairman of the Federal Reserve at that time, did two things that were pretty dramatic. One is he drastically increased interest rates, and that slowed down the economy. But in addition to that, he also reduced the money supply significantly, and that decreased inflation. So the combination of those two things, which were a very dramatic move by the Fed and also a risky move, essentially saved the economy from that time. Hey, if you're enjoying this video, please remember to like, subscribe, and share our channel. And if there's a topic you want me to cover in a future video, please be sure to include it in the comment section below. So why is stagflation so dangerous? It's dangerous because it creates uncertainty for investors. Investors are uncertain what the Fed and the federal government are going to do on the fiscal side and also on the monetary policy side to get them out of the stagflation environment. But it's also bad for businesses because businesses are now dealing with rising costs, but also a slower demand. So as a result, they can't raise their prices, and it's causing their profit margins to be much more narrow. It also creates confusion among policymakers because fiscal policy and monetary policy now are are at odds with one another. If the government decides to cut taxes, fiscal policy to stimulate the economy and grow GDP, that creates inflation. If the Fed decides to increase interest rates on the monetary policy side to lower inflation, that causes GDP and the economy to slow down. So here is a chart that shows why it's so difficult to fight stagflation. In normal economic times, the Fed using monetary policy and the government using fiscal policies would implement the following policies for inflation and unemployment. If the problem is high inflation, the Fed essentially raises rates and the government cuts spending. This has a side effect of slowing down the economy and increasing unemployment. If unemployment is high, if the problem is that unemployment is high, the Fed essentially lowers rates to stimulate the economy and the government increases spending also to stimulate the economy. This has a side effect of boosting demand, but it's also inflationary. So as you can see, if you fight inflation, you deepen the recession. And if you fight unemployment, fuel more inflation. So this is why stagflation is so frustrating, because you can't fix one problem without worsening the other problem. Now let's talk about the question on everybody's mind, is that are we going to see stagflation in the US economy? Well, basically, if we continue to see increases of inflation with higher unemployment and a slower GDP growth, then that's going to mean we're going to be in a stagflation type environment. But if GDP accelerates as the administration is projected for it to do and unemployment stays low, then we're not going to be in the stagflation environment. And remember, a healthy amount of inflation, usually 2%, is good for a normal economy. Another question I'm sure people are thinking about is whether or not stagflation is going to cause mortgage rates to go up. And the answer is unfortunately yes. If there is stagflation, mortgage rates are naturally going to go up because inflation pushes up interest rates, and interest rates are what drive mortgage rates. So where do you think we're headed? Do you think we're going to have more inflation? Are we going to go into a period of deflation? Or are we going to experience stagflation? Or alternatively, do you think GDP is going to start accelerating while unemployment stays low, hence resulting in a normal economic cycle? I'd love to hear your thoughts in the comment section below.